Hello students, today we are going to study about fundamental analysis. So when we are going to analyze about the company market structure, we analyze two things. One is the fundamental analysis and another one is technical analysis. So before an investor investing money in the market, analyzing the situation of economic is required, situation of the particular industry is required, then situation and of the company analysis is required. So let's study about the fundamental analysis. So what is fundamental analysis? It is a method of evaluating the intrinsic value of an asset and analyzing the factors that could influence its price in the future. So we are analyzing here two things. One is the intrinsic value of an asset, and here the factors that could influence the price in the future of the shares. So this form of analysis is based on external events and influences, as well as financial statement and industry trends. So let's see the EIC framework. So EIC framework consists E for economic analysis, I for industry analysis, C for company analysis. So let's study one by one. The first one is the economic analysis. So we all know, we have studied that how economic situation of the country impact totally on the stock prices and the performance of the industries and their profitability and the variation in the stock market indexes. So the level of economic activity has an impact on investment in many ways. If the economy grows rapidly, the industry can also be expected to show rapid growth and vice versa. So it's all about the situation of economy, which takes in the complete industry to up or maybe take down also. So when the level of economic activity is low, stock prices are also low. And when the level of economic activity is high, the stock prices are high, reflecting the prosperous outlook for sales and profit of the firm. The analysis of macroeconomic environment is essential to understand the behavior of the stock prices. The commodity analyze macroeconomic factor as follows. The first one comes is the GDP. So GDP indicates the rate of growth of the economy. GDP represents the aggregate value of the goods and services produced in the economy. GDP consists of personal consumption expenditure, gross product domestic investment, and government expenditure on goods and services, and net export of goods and services. So the GDP, it all talk about the present situation of the country. If the GDP is growing high, it means the economic situation of the country is very nice and very good. Then investor can think of it. So next is the savings and investment. So it is obvious that growth requires investment, which in turn requires substantial amount of domestic saving. The stock market is a channel through which the savings of the investors are made available to the corporate bodies. If the savings are distributed over various assets like equities, shares, deposit in the mutual fund units, real estate, and bullion, and the saving and investment pattern of the public affect the stock to a great extent. So if this habit develops, so these savings can be utilized for the industrial health and their development projects. Next comes the inflation. So we all know inflation matters a lot. Okay. So in inflation, we know the purchasing power of the money decreases. So along with GDP, inflation rate also increases. Then the real rate of growth would be very little. The demand in the consumer product industry is significantly affected if the inflation increases. The industry which come under the government price control policy may lose the market. So for example, sugar is the best example. Always you can see the strikes regarding it. The government control over this industry affect the price of sugar and thereby the profitability of industry itself. So if the is a mild level of inflation, it is good to the stock market, but high rate of inflation is harmful to the stock market because savings decreases, the price of the product increases, the purchasing power decreases. So it ultimately affects the stock market. Next comes the interest rates. The interest rate affects the cost of financing to the firms. A decrease in the interest rate implies lower cost of finance for firms and more profitability. So more money is available at lower interest rate for the brokers who are doing business with borrowed money. So available of cheap fund encourages speculation and rise in the price of the shares. So if interest rate increases, so the cost of borrowing is high. So then obviously everything becomes higher. So interest rate decreases, then obviously the borrowing will become cheap. So business could avail this opportunity and start their businesses or expand. And next comes the budget, the most important factor. Again, the budget draft provides an elaborate account of the government revenues and expenditure. A deficit budget may lead to high rate of inflation and adversely affect the cost of production, that we all know. So the surplus budget may result in deflation. So hence balanced budget is highly favorable to the stock market. And next is the tax structure. So this is again one of the important factor for the including industry also, including company also, and including investors or individuals also. So every March we know there will be change in tax structure. So every government changes frequently at the time of budget. So we know the financial year is from April to March for Indian economy. The business community eagerly awaits the government announcement at the end of the March regarding tax policy and what concession and incentives are going to be given by the government to encourage the industrial investment. Okay, and it depends on the different industrial also, particular industry. So if tax relief given, savings encourages. Okay, so always that matters a lot in the economic condition and the development of the stock market also, even the most important to the companies also. Next is the balance of payment. So it describes the situation of the country, and it is a record of a country's money received from and payments abroad, how much money has gone out and how much money has came in the country, and the difference between the receipts and payment may be surplus or deficit. So it decides the currency value also of the country. So balance of payment is a measure of the strength of rupee on external account. If the more the imports, the it reduces the value of the currency. The more the exports, so money flow should be inflow should be higher than the outflow. Next is the monsoon and agriculture. So always we have learned that monsoon plays a gambling with the Indian market. So if the monsoon is good at stable rate, then the agriculture growth happens. Then automatic income increases because Indian most of the population lives in villages. So if agriculture production increases, automatically it related industries develop. So even businesses also develops. Next is the infrastructure facility. So they are very essential for the growth of industrial and agriculture sector. A wide network of communication system is a must for the growth of the economy. A regular supply of power without any power cut would boost the production also. And banking and financial sector also should be sound enough to provide adequate support to the industry and agriculture, giving loans and facilities. So good infrastructure facility affect the stock market favorably. So India is considered as developing country since it's working on the development of infrastructure. Next is the demographic factors. The demographic factors data provide detail about the population by age, occupation, literacy, and geographic location. And this is needed to forecast the demand for the consumer goods. So the population by age indicate availability of able workforce, how much labor available, the availability of the cheap labor because India always known for the available of cheap labor. Okay, and if we consider the what do you call the mm, multinational companies, they always look for the skilled type of labor at the lower rate salaries. So Indian labor is cheaper compared with the Western labor force. So you population by providing labor and demand for products affect the industry and stock market. So that's why in India you can see the most of the IT sector BPOs outsourcing companies. So next comes the industry analysis. So industry analysis, we all know. So industry is a group of firms that have similar technological structure of production and produce similar products. For example, we say banking industry is the set of all banks. pharmaceutical industry, automobile industry, okay, so insurance industry. So like this, we have different industrial industry in the country. For the convenience of the investor, the broad classification of industry is given in financial dailies and magazines. So companies are distinctly classified to give clear picture about their manufacturing process and products also. So if you see what criteria should be evaluated in industry analysis, the first comes is growth industry. So the growth industry have special features of high rate of earning and growth in expansion independent of business cycle. The expansion of the industry mainly depend upon the technological change. Okay, the all about recession, how it impact the life cycle, how it comes. We know the life cycle: recession, boom, stagnant. Okay, and inflation. So that all matter in the industry analysis. What type of industry it is? If it's a growth industry, obviously they need to be invested money. Next is cyclical industry. The growth and the profitability of the industry move along with the business cycle. Okay, during the boom period, they enjoy growth, and during depression, they suffer a setback. If we look at example, the white goods like fridge, washing machine, and kitchen range products command a good market in the boom period, and the demand for them slackens during the recession. And next is the defensive industry. So defensive industry, this type of industry defies the movement of the business cycle. Okay, they defend with the cycle movement of the business. If you take example, food and shelter are basic requirement of humanity. We all know the food industry withstands recession and depression also. And the stock of the defensive industry can be held by the investor for income earning purpose, because in time of even recession or inflation also, these industry perform well because they are all supplying the basic needs of the human being. Next comes the cyclical growth industry. So this is a new type of industry that is cyclical, and at the same time it is growing also. If you take example, automobile industry experience period of stagnation, decline, but they grow tremendously. We have seen it. So the changes in technology and introduction of new models help the automobile industry to resume their growth path. And next comes the cost structure and profitability. Okay, so the cost structure, that is fixed and variable cost, affect the cost of production and profitability of the firm. In the case of oil and natural gas industry and the iron steel industry, the fixed cost of production is high, and the gestation period is also lengthy one, because they are very highly investment involved industry. So higher the fixed cost, the component, the greater sales volume is required to reach the firm's break-even point. So these type of industry always look into the huge sales, and the BP period is also very huge. So once these type of industry break point is reached and the production is on the track, the profitability can be increased by utilizing the capacity to full. And next is the nature of the product. Product produced by the industry are demanded by the consumers and other industries. If industrial goods like pig iron, iron sheet, and coils are produced, the demand for them depends on the construction industry. So likewise, same thing with the textile machine tools industry, produce tools for the textile industry, and the entire demand depends on the health of the textile industry. And next comes the government policy. This impact a lot for the industrial development. Okay, so before going to government policy, there is a nature of the competition. So nature of competition, always essential factor. It determines the demand for a particular product. So its profitability and the price of the concerned company scripts. So supply may arise from indigenous producers and multinational. In case of detergent, it is produced by indigenous manufacturer and distributed locally at a competitive price. So likewise, the nature of competition describe how much the industry is developing and involvement of multinational company, and that decide the competitiveness in the market. Next is the government policy. So it is like a nerve for the industry, and the effect differ from industry to industry because it's totally depend on government how they are going to make the policies. Tax subsidies and tax holidays are provided for export-oriented product and SEZ industries. Government regulate the size of the production and the pricing of certain products. So they decide everything regarding the onion, you say, sugar, you say, iron, supply, you say, fertilizers, and pharmaceutical product. That all depends on government policy. Next comes the labor. The analysis of labor scenario in particular industry is of great importance because different industry require a different type of labor class. The number of trade unions and their operating mode have impact on labor productivity and modernization of industry also. So if we say the textile industry is known for its militant trade unions, if the trade unions are strong and striker occur frequently, so we know that it would lead to the fall in the production. And next is the R&D, research and development. That is one of the biggest tool which take industry to the higher extent. So for any industry to survive the competition in the national or international level, so nowadays because of after globalization, privatization, liberalization, there is a huge competition coming out. And to survive this, there should be a good strong R&D to bring about the new technical equipments and techniques of production and processing to be in the market. So they should have a strong R&D. Next is the pollution standards. So if the pollution standards are very high and strict in industrial sector, we all know Kyoto Protocol. For some industries, it may be heavier than other. For example, if you take leather industry and chemical and pharmaceutical industries, the industrial effluents are very high. And next comes the SWOT analysis. So the strength, weakness, opportunity, and threats of the particular industry has to be analyzed before investing in that particular industry. And next is the industry life cycle. So what type of life cycle that industry is going through? Is it in a pioneering stage or a rapid growth stage, maturity and stabilization stage, or declining stage? So this has to be analyzed. So if it's in pioneering stage, that can be investment, sales growth will be less. In rapid growth stage, the rapid growth stage sales will be very high, but technology adoption is also new comes. But in pioneering, it's an just okay technology, very low technology comes, but when at rapid growth technology grows. Maturity and stabilization, it depends on the GDP rate on the country going on, and the sales will be stabilized. So declining is all about going down. So if you look at black and white TV, that has gone, the camera phones have gone. Okay, slowly we have seen so many products have gone out of the market because of the declining of them. Now, coming to the next is the company analysis. So, company analysis is more about the two things. One is the financial analysis that act as a most important thing, and other things we need to study. In the company analysis, the investor assimilates the several bits of information related to the company and evaluate the present and future value of the stock. So first we see analyze the economic situation of the country. Then we come to the industry analysis, the particular industry where we would like to invest. Then in industry, which company we are going to invest, that has to be analyzed. The risk and return associated with the purchase of the stock is analyzed to take the better investment decision. So obviously we have seen how risk and return are calculated and how we can you calculate it and how it will affect the return of the stock. Evaluation process depends upon the investor's ability to elicit information from the relationship and the interrelationship among the company related variables. Now, if you see the components need to be analyzed in company analysis, the first, the competitive edge of the company. So competitive edge of the company we can analyze through market share, growth of sales, and stability of annual sales. So if company is performing very well, so it depends on the market share, how much they have, the total market of sales, and how the growth of sales are affecting from the past years, and the stability of annual sales comparing to the old data. These things are analyzed that can give the competitive edge of the company. Next comes the sales forecast. So this plays an important role, analyzing the future market about the company. So next year, how much they are expecting sales will increase next year, after 2 years, 3 years, or 5 years. So that plays an important role because more the sales, the revenue increases. The revenue increases, the profit increases. So go on the EPS also increases. And next comes the capital structure of the company. So we know capital structure. It is the combination which is included equity share capital, preference share capital, debt capital. So this impact a lot while giving the EPS. The combined capital structure is very nicely made. So equity shares holders also get the dividend. If the debt instruments are used more, then most of the money goes to interest rates, but equity shares holders will not get much money from it. So the capital structure should be designed very well. And next most important thing comes in company analysis, that is management. So we all know the management, the manager, the ability to get along with people, the style of the company, the leadership style, analytical competence of the company, and industry how it is performing, the judgment level, ability to get the things done. So these all things matter when they are choosing the management. So we have seen the same where if any CEO has been taken retired or they are leaving the company, their shares value have gone down because people have invested money depending on their the manager who is going to lead the team. Next comes the operating efficiency. So any operating efficiency of company directly affects the earnings of a company. Okay, because it's all related to how the efficiency of the company is. So an expanding company that maintains high operating efficiency with low break-even point earns more than the company with high break-even point, because gestation period should be very less. Lesser the gestation period, lesser the break-even point. Once the break-even point is reached, then companies start earning profits. So it's totally dependent on the operating efficiency. So if the operating ratio of the company is stable, then the earnings will be high, because it's totally dependent on the use of the fixed asset, and with the raw materials, labor, and management would lead to more income from the sales. And next comes the operating leverage. If the firm's fixed cost is high in the total cost, the firm is said to have a high degree of operating leverage. So fixed cost should be very less, because operating leverage should not be high, it should be very less. So leverage means that use of labor to raise a heavy object with a small forces. We know this. So high degree of operating leverage implies other factors being held constant. The relatively small change in the sales result in large change in return of equity. So that's why the operating leverage matters a lot. So this can be we have already studied in our financial management subject how operating leverage has been calculated. Next comes the important thing, that is the financial analysis. So financial analysis is all about the analyzing the balance sheet of the company that we have studied in our accountancy subject and also in financial management subject, and then the profit and loss account, how we evaluate trading and profits and loss account. We can come through that. So if you look at the P&L account of any company, we can easily analyze the situation. Then the analysis of financial statement, comparative financial statement, trend analysis, common size statements, fund flow analysis, cash flow analysis, and ratio analysis. So when we are going to analyze the ratio analysis, so we come through different level of ratio analysis. We calculate liquidity ratio, turnover ratio, leverage ratio, profit margin ratio, return on investment ratio, and valuation ratio. So this can be calculated with the using help of the financial statement of the company. So with this, we can decide whether to invest in that particular company or not. So this is the end of the fundamental analysis. I hope you have enjoyed the session.